Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock I found that is really small, but at the moment they are producing some incredible returns. And the stock is called Kura Sushi. We can see over the last year, they're up 25%, outperforming the rest of the market. And over the last 5 years, they're up 567%. They actually only went public in August of 2019, but since then their share price has increased from $14 up to almost $100 per share. Pretty impressive. Their market cap is only 1.1 billion, so they have a lot of room to grow. And so in this video, I'm going to look into some of their impressive earnings growth. I'm going to look at their financial statements, some of the recent news that came out surrounding the company, and then I'm going to analyze some of their metrics in Microsoft Excel to get a better understanding of the company. So right here, this article is titled, "Here's Why Kura Sushi Stock Popped Today." Some key points they touch on. Kura Sushi is growing fast and is raising its forecast for the fiscal year. Company's profits came in ahead of market's expectations, causing the stock to approach an all-time high. So right here in the first article, in the first paragraph, they point out that Kura Sushi is a small restaurant chain with only 47 locations, but each location packs a punch. The company generated $50 million in third quarter revenue, up 29% year over year. Top line growth also included 10% jump in same-store sales. So their revenue didn't just increase because they were opening new stores, it also increased on a case-by-case basis for each individual store, so that's very impressive. Right here in the second paragraph, they point out the real surprise for Kura Sushi came from profitability. They brought in $1.7 million of net profit, which was more than triple the net profit they had in the prior year's quarter, where they had only about $500,000 of net income. And then right here, they point out for the future long-term, Kura Sushi believes that they can have 300 locations. That would basically be 6 times the amount of locations they currently have. But it costs $2.5 million to open a new location, so expansion is pricey. That's why management recently tried to bolster their balance sheet, taking advantage of the strong stock price by offering some stock to raise $64 million so that they could position themselves to continue to expand. And if they are positioned to continue to expand, then that means that they could end up producing some pretty hefty returns for shareholders in the future here. So right here, these are their financial statements. We can see this is their balance sheet. Total assets are up from $200 million to $286 million. We can see most of their business is financed by equity. They have around $186 million of additional paid-in capital, common stock, and they only have about $126 million of total liabilities. For their income statement, we can see that sales are up from $37.9 million to $49.2 million, an increase of about 28%, just like the article pointed out. And we can see that for net income is up from $477 million to $1.68 billion. That's an increase of basically 240% year over year. So that's pretty impressive. But unfortunately, we can see from the 9-month chart, they're actually at a net loss for the entire year. But if they are able to continue producing net income like they have in the last quarter for the rest of their operating future, then this company is definitely going to end up turning a profit by next year. So that would be pretty exciting to see. And lastly, right here, we can see their cash flow statement for the first 9 months of 2023 and 2022. Operating cash flow decreased from $17 million to $7 million. And then we can also see from their financing activities, this is what the article touched on. They raised $64 million from a stock offering, but at the moment they aren't really repurchasing stock or paying out dividends. They're still a very young and new company, very small company, but they are growing pretty rapidly. So it's pretty interesting to see. It's definitely a stock that I'm going to keep my eye on. So right here, this is a discounted cash flow model to figure out the intrinsic value per share for Kura. Yahoo Finance is estimating that the company is going to grow at a pretty impressive growth rate of 37% year over year. And they have been growing pretty fast, as we saw from the earnings growth. But unfortunately, for free cash flow and net debt, they are sitting at negative for their balance sheet and their free cash flow for their most recent full year. And they have around 10 million shares outstanding. So unfortunately, based on their negative free cash flow metrics, it's difficult to try to measure the valuation of the company based on free cash flow because they don't really have any. So the discounted cash flow model ends up being moot. But they do have, as Yahoo Finance estimated, a 37% growth rate. And as we saw, they had positive earnings in the most recent third quarter. So if they're able to continue growing at that pace, and they will probably end up having positive free cash flow in the near future here. For our competitor analysis, I compared Kura Sushi to Denny's and the Cheesecake Factory. We can see that right now Kura Sushi is the only company on the list that isn't profitable. for the entire, or for their most recent full year. Denny's is most profitable at 16% from a 27% gross profit margin. So clearly the majority of their costs go from cost of goods sold, not operating expenses. For PE ratio, we can see that Kura Sushi is trading at a really high price to earnings ratio, currently trading at almost 2,000 times earnings. Denny's is pretty low at 13 times earnings. Cheesecake Factory is around middle of the pack. They don't really have that impressive profit margins or PE ratio, but they are the only company that pays a dividend with a 2.5% dividend yield. So based on this, it looks like Kura Sushi is definitely lagging behind the pack based on these metrics. So we'll see if they're able to make a turnaround in the future. Based on that, you probably want to give it to Denny's for this competitor analysis. And then to end off the video, I wanted to compare Kura Sushi to some of the other companies we've looked at. In terms of intrinsic value, we saw we weren't really able to effectively use a discounted cash flow model, so they aren't going to make it onto this table. Google, Alibaba, GE, and Etsy are the only companies we've looked at so far that are trading below intrinsic value per share. For growth rate, Kura Sushi shoots to the top of the list. They have a higher estimated growth rate than NVIDIA, with a 37.38% estimated growth rate. For profitability ratios, they are not profitable, so they aren't going to make it onto either table, which is owned by Adobe's 86% gross profit and Microsoft's 36% gross profit. But as we can see from the bottom three tables, although Kura Sushi doesn't pay a dividend, for year-over-year revenue growth and earnings growth, Kura Sushi shot straight to the top of the table for both. They had 29% year-over-year revenue growth, and they also had 240% year-over-year earnings growth. So they completely wiped the rest of the companies out of the water, blew them out of the water, because 240%, that's extremely impressive, especially considering the company is so small. If they're able to continue growing like this, they have a lot of runway to grow. They only have about 50 stores right now, so if they're able to get to the 300 stores and each store is producing about $1 million, it's $300 million up from there, about $50 million in sales right now. So that would be pretty impressive growth for Kura Sushi. And then lastly, for stock performance over the last 5 years, they also shoot near the top of the list, top three here, pushing NVIDIA down to fourth with their 567% return over the last 5 years. And the company also doesn't even pay a dividend. So that's pretty impressive growth. Only two companies beating them are AMD and Tesla at 1,000%. So based on this, it looks like Kura Sushi, from an earnings and revenue growth perspective and from a return to shareholders perspective, they're very competitive. They're shooting near to the top of the list or top three, but they're currently not profitable. For growth rate, they have the highest growth rate so far out of any company we've seen, but they don't have positive free cash flow metrics, so we aren't really able to measure the intrinsic value per share for the company. And compared to other companies and other small restaurant chains like the Cheesecake Factory and Denny's, it looks like they're really not doing that well because they're trading at such a high premium right now. Obviously, investors are expecting a lot of growth from Kura Sushi, so that's why the stock is currently trading at such a high premium. But if they are able to turn a profit, then this company is going to become a pretty attractive investment in the near term to long term. So let me know in the comment section down below what you guys think of Kura Sushi. I'm definitely going to be keeping my eye on this stock. I might buy a few shares, but let me know in the comment section down below what you guys think. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.